Many people are interpreting recent market moves in the light of Bretton Woods III. This is an idea about a new world monetary order created by a strategist at Credit Suisse called Zoltan Pozsar. So in this video, I'm going to take apart those ideas because I think many people don't understand them. They are very technical. And then I'll also come up with 4 potential consequences of his ideas, which, if correct, could really affect your portfolio, but only if they're true. So now let's look at Bretton Woods III in a bit more detail. So beside me here, you can see a picture of Zoltan Pozsar, and it seems rather odd because he's saying that central banks might have to bail out commodity traders, which on the face of it is an odd thing to say. But at the end of this video, hopefully that will make sense. But the key thing is he thinks commodities are going to be at the core of our portfolios, but also the monetary system in future. The timeline above me shows you the periods for Bretton Woods I, II, and III. It all kicked off with an agreement between all the major powers of the world in 1944 in this hotel room you can see beneath me. Then that agreement broke down in 1971, and it led to an informal agreement which became known as Bretton Woods II. And then according to Zoltan, we've got a new era called Bretton Woods III, which started in March of 2022. So our story starts with Bretton Woods I, and the idea behind this system was that everything was grounded in the value of the dollar, but the dollar itself was grounded in the value of gold. So 1 ounce of gold was convertible into $35, and then the value of the dollar was fixed relative to all the currencies you can see around me. So this was a fixed exchange rate mechanism. Currencies weren't allowed to float relative to one another. They were fixed and very stable. Another hallmark of the Bretton Woods period was that it was one during which the pound as a reserve currency started to diminish and the dollar took its place. Now, the idea of a reserve currency is that if you as a country export more than you import, then you'll have an excess of foreign currency. Then the question is, which currency should you store that reserve in? And that's what we mean by a reserve currency. Usually it's the currency which is mostly used for trade. So sterling was very widely used for trade up till about 1950, but you can see that the dollar very quickly started to take its place. And that's the world in which we currently find ourselves, one in which the dollar dominates as a reserve currency. The breakdown of the Bretton Woods Agreement in 1971 leads on to the Bretton Woods II period. Now, there was no formal agreement called Bretton Woods II. Instead, you could think of it as the era of fiat currency. Currencies were allowed to float relative to one another, set by market forces, and they weren't fixed relative to the value of gold, say. But what's key to this period is the idea of price stability, and this is the job of a central bank. So the mission statement you can see below is about price stability taken from the ECB website. And what they're talking about is the rate of inflation. And this is the rate at which the overall prices for goods and services change over time, and they're aiming to keep that low, stable, and predictable. Now, as we'll see, that's incredibly important if you want to park your money in that currency. So here I've shown the trading relationship between the US and China during this Bretton Woods II era. Now, this was characterized by the US buying a lot of Chinese goods, which then generated dollars for China. China would then buy US treasuries. Why not? Because they're very safe, they're very stable, and the US Central Bank, the Federal Reserve, will ensure they're not eroded by high US inflation. And China was certainly generating a lot of excess reserves. You can see that they built up to almost $4 trillion in 2014. And although it has fallen since then, it's still well over $3 trillion in reserves. Now, a lot of those are parked in US dollars. Now, I've shown this for the US and China, but for any country which has excess reserves, you can effectively show the same graph, although it doesn't have so many reserves as China, which has the biggest. And according to Zoltan, in 2022, we entered Bretton Woods III. And what triggered this new era for money was when Russia invaded Ukraine. And as a consequence of that, and the very severe sanctions imposed by the West, Russia no longer had access to its foreign exchange reserves. And those foreign exchange reserves were worth about $640 billion, but it could only access 300 billion of them as a result of the sanctions. Now, this actually sets a precedent, according to Zoltan, such that any central bank would now be worried that its assets could be confiscated if they were held in, say, US dollars, if it falls foul of US policy. Now, this has a number of consequences if he's right, which we'll go through now. I think there are 4 of them which are very important. If you find the interplay between markets and macroeconomics interesting, it's the kind of thing I discuss every week in my weekly market roundup. It's free, it's punchy, I sent it out on a Friday evening, I try to make it entertaining, and it's also available for you to sign up very easily. Just click on the link beside me and in the description beneath me. The first consequence is that commodities matter again, just as they did under Bretton Woods I. Now, we're all keyed up to the price of oil at the moment because, of course, Russia exports 11% of the global supply. But it's not just going to be about oil, it'll be about every commodity. And Russia itself exports many other commodities, such as wheat, where it produces 1/5 of the global supply, palladium, where it produces 1/4 of the supply, and fertilizer, where it produces about 23% of the global supply. So Zoltan draws a nice analogy between subprime assets in 2008, which triggered the global financial crisis, and Russian commodities, which he considers to be subprime. And he contrasts that with prime assets, which are non-Russian commodities. And these were kind of like treasuries in 2008. These were the safe haven assets which everybody wanted to protect them from the equity storm. So for example, if we look at the price of oil, it's not the same in every region. So if we look at Urals oil, which is Russian oil, that's trading at a big discount to, say, Brent crude, which is delivered in the North Sea. In fact, the size of that discount is huge and growing. It's currently over $30. So this is a clear example of a subprime commodity. And what he says is that China is going to play a key role in bringing those subprime commodity prices and prime commodity prices back into line with one another. And that's because China has lots of foreign reserves, but it also has no sanctions which it's imposed on Russia. So the world that Zoltan sees is a multipolar world, where we're no longer dominated by US dollar trading, but say, for example, you want to trade with China, you trade in Renminbi. And if you want to buy Russian oil, you'd buy it with Russian rubles. So in this new multipolar world, we'd see a weaker dollar and a stronger Renminbi. If we look at the largest international holders of US treasuries, China completely dominates. It currently holds over $1 trillion worth of US treasuries, whereas Russia has effectively cut its US Treasury holdings to zero. And some people say that that was in preparation for this invasion of Ukraine, because those treasuries, if it doesn't hold them, can't be confiscated. So if China chooses to bring the non-prime commodity prices, that's Russian commodity prices, in line with the prime ones, which are non-Russian commodity prices, then this is one way in which it could do that. It could sell some of its treasuries, and of course that would push up the yields in the US because it would push down prices, the two move in opposite directions, and it could buy the subprime Russian commodities with the dollars that generated. Then it could use some of the dollars to lease vessels. These are the vessels that we'd also use to ship our commodities, so that would push up shipping costs and push up inflation in the West. And it could also use the ships to store some of the commodities if it runs out of space to store them in China. A second approach, which also causes problems in the West, is that the People's Bank of China, the central bank in China, could print renminbi and then use those to buy commodities from Russia. Because they wouldn't have to store any dollars in US treasuries, that would still push up US yields because a big buyer of treasuries would suddenly disappear. And it would still be inflationary because there'd still be a supply squeeze on vessels used to ship goods. Now, under Bretton Woods II, there were lots of dollars generated by trade which had to be stored in foreign bank accounts. So that's called the euro-dollar market. This is nothing to do with euros, these are just dollars stored in non-US bank accounts. And usually those would be stored there in order to settle international transactions. So if instead of that we move to a renminbi-dominated market for people who trade with China, of which there are many of course, then we'd see a new market, and this would be the euro-renminbi market. and this would signal the end of the dollar hegemony which we've seen under Bretton Woods II, and a gradual rise in the importance of the renminbi as a trading currency. So whichever of those two methods China uses to bring the spread between prime and non-prime commodities into line with one another, it's going to have three consequences: higher inflation in the West, higher US treasuries, even though they've spiked this year, they'll go even further, and also higher shipping costs, which will also be inflationary. The third consequence is instability, and the trigger for that instability is commodity prices becoming very volatile, surging upwards and then crashing back downwards. We've already seen it to some extent with the margin calls on the London Metals Exchange, in particular for the nickel market. But one consequence of that volatility might be that commodity traders fail to meet those margin requirements and then eventually become bankrupt. Another worry is that central clearing counterparties, which are actually designed to reduce counterparty risk, actually focus that risk, and it might be that clearinghouses themselves fail. That would be a systemic problem which would eventually lead to government bailouts. And the fourth consequence would be the end of globalisation. This is something that Larry Fink of BlackRock has talked about, but we'd have more resource nationalism, that's something we've already seen, but also stockpiling of commodities, because you don't want to be left shortchanged if there is a supply shock. And then finally, we've seen many countries start to rationalise their supply chains and try to make as many of them as domestic as possible. So I hope you can understand what Zoltan is now saying a little bit better, but also interpret what's going on in markets in terms of Bretton Woods III. I think even if the ideas are wrong, I think probably many of them are, at least they're interesting and help us see the world in a new light. So also, if you're at a dinner party, you can bore your friends with a new world monetary order, which is always a bonus. Remember our offer with our weekly roundup? You'll find a link to that beside me and in the description beneath me. And as always, thank you for listening.